What's ahead for property this year? Is this the end of interest rate cuts? We started the year with lots of optimism, and now there's our fair share of turbulence. We've had a coronavirus epidemic hit us, tragic bushfires, overseas political tensions. How's that going to affect our property markets and our economy? That's some of the many topics I discuss in today's Property Insider chat with Dr. Andrew Wilson. You probably are aware that once a week I do a video with Dr. Andrew Wilson that you can watch on my YouTube channel or at propertyinsiders.info. But this is the audio of the recent video that we did where we discuss a lot of things so that at the end of today, you're going to have a better handle of what's ahead for property in the next little while. And at the end of the session, Dr. Andrew Wilson is going to give you his predictions of what's going to happen to property values in our main capital cities. We're also going to discuss auction trends, the home loan trends, what's happening to interest rates, the RBA, are they just holding off, or is this the end of interest rate cuts? What's happening to inflation? And all those headwinds, the US-China trade pact, Brexit, coronavirus, and the unfortunate tragic bushfires. We also talk a bit about employment, consumer confidence, and our housing markets. Boy, we're going to cover a lot, but the aim is to make you a more educated property investor. Now, you can also catch Dr. Andrew Wilson live in Melbourne, Sydney and Brisbane at my annual property market and economic update seminars that we're running in Sydney, Melbourne and Brisbane in March and April. That's coming up really soon. And while they normally cost $99, if you go to propertymarketupdate.com.au, propertymarketupdate.com.au, and put in the coupon code podcast, you can come as my guest. So if you enjoy what you're hearing today, boy, are you going to love spending a full day with us to hear about what's in our property markets. Okay, with that introduction, welcome to today's show. Let's get on with this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
The new year has commenced with more than its fair share of turbulence. We started the new decade filled with optimism and then fell back to earth with tensions overseas in the Middle East, the outbreak of the coronavirus, the tragic Australian bushfires. But now we're far enough into 2020 to get an idea of what's happening in our property markets. So in this week's episode of Property Insiders, Dr. Andrew Wilson, Australia's leading housing economist, and I are going to discuss what's happening in the economy, in our housing markets around Australia, and what the data suggests could be ahead for real estate. Welcome, Andrew.
Thank you, Michael. And I suppose I could say Happy New Year. It is a little belated, but what I'm really trying to say is Happy Property New Year, because we're certainly now at the early stages of the property market for 2020. And we do have now some more concrete insights into how the market is likely to travel, particularly over the first half of the year.
Yeah, well, we have to give it a couple of weeks to see how, in particular, the auction results are going, because December, January is a quieter month with seasonal adjustments. It's actually hard to believe we're well into 10% of the new year already, Andrew. Look, we often talk about unexpected X factors that come out of the blue to upset the best-made forecasts. And boy, have we had our share of these already this year, both here and overseas. So, Andrew, today I'd like to ask you a bit about how our property markets have already performed so far, and then we can look at the economic uncertainties that affect our markets. So let's start with property. A number of data sets are suggesting that property values have continued to rise around Australia, and the property upturn, which started in Sydney and Melbourne in the middle of last year, has now become more widespread, with housing values rising in January across every capital city. And median prices are one way of looking at things, but they're a bit of a lagging indicator. Auction clearance rates are a more in-time indicator of the market. So how's it been going so far, Andrew?
Well, we're 3 weeks into the auction season, Michael, and volumes are now at a level where we can get some, more reliable results. And clearly the market has started off on the front foot. As you suggested, it was a strong second half to last year, culminating in boom time clearance rates in Sydney particularly, and quite strong results in Melbourne as well. And that's continued this year. Sydney's recorded 3 consecutive weekends above 80%. That's the first time since 2015 that market has recorded that level of activity. And the Melbourne market has tracked just under 80% over the first 3 weekends of February. And interestingly enough, of course, that shows there's plenty of competition for property amongst buyers. But the difference this year to last year, not only higher clearance rates, is we're seeing higher numbers of properties being offered for sale. In fact, quite strong numbers of listings right through the first 3 weekends of February. And that's likely to continue, particularly in Melbourne, with some very strong numbers coming up, which we always see a Super Sunday of auction activity in the weekend before the Labor Day long weekend in Melbourne. And that's certainly looking to be the same this year, where we'll see well over 1,000 properties going under the hammer. So high clearance rates from high listing numbers really show you that there's plenty of early season energy from both sellers and buyers in our property markets.
One of the results that came out recently was the December home loan figures, which confirmed the revival of our property markets. But Andrew, a lot of fuss was made about them, but they still remain well below the figures of 12 months ago, particularly for property investors.
Well, this is take a cold shower time again, Michael, which the media, I think, always ignores that advice, but anything to sell a paper. Those numbers were quite strong, a strong rise over December compared to November, but a year-on-year data, 19 versus 18, was still lower, and that is, I guess, reflects the house price environment, because even though Melbourne and Sydney had strong second half year price growth levels, they still remained below their previous price peaks of 2017. And of course, as we've discussed, that's what's been driving the Sydney and Melbourne markets, is that catch-up energy where buyers are really still buying at a discount, so plenty of incentive for them because prices are still below where they were 2 years ago. And that's why the smaller markets haven't had that same sort of springboard of activity, because their price levels, Adelaide and Brisbane particularly, are around about peak levels. So there's none of that sort of suck-up energy to fuel prices growth that Melbourne and Sydney have. And of course, that's the same when we look at the home loan data. Although it's growing in line with prices growth, it's still below its peaks of 2017 and 18. But it was very revealing, the home loan data, when we drill down a little bit, Mike.
So, Andrew, it's not a homogenous home loan market. Investors are out of the market at the moment, but first home buyers are back with vengeance, aren't they? And owner-occupiers are too.
Well, it's been an owner-occupier revival, Michael. We still have issues in terms of the lending environment for particular buyer groups. But yes, look, owner-occupiers have been strong. We did see also a rebound in first home buyers over the second half of the year. Now, that's really a case of when prices start to rise, we do see first home buyer activity reactivating, because there's nothing worse for a first home buyer, of course, than an environment of rising prices, because they don't have a trade-in property to bring into the market, and they are fearful of seeing prices rise at a faster rate than they can save their deposits. So we saw a strong second half of the year from first home buyers. Owner-occupiers, of course, taking advantage of that still discounted market in Melbourne and Sydney, but really no action with investors, a little bit of a trickle up. But the proportion of investors in the marketplace now is certainly at near record lows. Just under 30% of activity is net for home lending is investors. And I think that's a very interesting statistic, given that we've had this strong revival in the market over the second half of.
Well, in my mind, it's they're having difficulty getting finance, because we haven't had as many inquiries at Metropole from investors like this for years, but they're still being challenged because of the banks looking much more carefully at their serviceability.
I believe you're completely right, Michael. I have conversations with people who are saying that it's either investors not interested in the marketplace, which I think's really counterintuitive given how strong prices have been growing in Melbourne. I think investors, savvy investors, would be looking to take advantage of what is still a significant upside to prices growth in the marketplace. And certainly we have no doubts about prices growth in the market now and its energy going forward. So that's always an attractive feature for investor demand. So I do think, as you said, that it's a question of still having difficulty for investors getting finance. I think there's a culture of negativity that's now permeated the banks, particularly in regard to investor lending. I think they're over managing risk. And this is really, I think, a significant issue. It's obviously a consequence of the Banking Royal Commission, those APRA actions, which have really, I guess, created a gun-shy environment for investor lending with the major banks. And really, it's also constraining their capacity to build profits. And I do think that this needs to be looked at quite seriously, because it is an impediment to market dynamic, and it's only going to end up with shortages if it continues, particularly rental properties, if it continues over the longer term, Michael.
Well, that makes sense. Now, at the beginning of this month, the Reserve Bank met for the first time in 2020 and it decided to keep interest rates on hold. Well, last year it signalled its intention to continue easing monetary policy. I believe the Reserve Bank held off further interest rates, it said its minutes, because of the stronger housing market. But it also did highlight the new risks to the economy from the coronavirus. Andrew, is this the end of interest rate cuts, or are they just holding off?
Well, they're holding off, Michael. There's no doubt it's more of a wait and see approach here. Again, I'm fearful of any commentary from the Reserve Bank that focuses on housing markets. That really got them into trouble in 2015, 16, 17. They overemphasised house price movements, particularly in Melbourne and Sydney. And I think they left interest rates on hold for too long. And we lost momentum in terms of trying to revive, particularly incomes in the economy. I hope that the Reserve Bank don't get sucked into what is just a modest revival in housing market activity in terms of determining interest rate policy. But I think the big changes, if we look from the end of last year, Michael, to the beginning of this year, are clearly that the unemployment position improved. The Reserve Bank had signalled that it was prepared to cut early in 2020, that it was likely to see 2 interest rate cuts, perhaps over the first half of 2020, and that their main concern was the unemployment situation, the labour market. Of course, if you remember, in October we saw unemployment rising, the trend unemployment was rising. We actually saw a decline in jobs growth, which was of a real concern. After a long period of jobs growth, we saw jobs falling for the first time in October in a while. But the data that came through, of course, there is a lag between that unemployment data but when we got the November and December data, it clearly had improved. We saw unemployment falling, jobs growth resuming, and I think that was a clear factor, given that the trend unemployment was starting to fall and trend employment growth was rising, that the Reserve Bank decided that they would take now a wait and see approach on interest rates. That's been really the big change in terms of the macroeconomic position. And I think that what that means, Michael, for interest rates is that we would have to see a reversal of those current trends in the unemployment rate and jobs growth to bring back again on the agenda a rate cut. So I think that that's now likely to be some months away until we do see perhaps a deterioration in the labour market. And if we don't see that, as you suggested, and as it does, if it continues to improve, I think we may have seen the end of the current interest rate cutting cycle.
Well, just to put some figures around what you said, unemployment fell to 5.1% at the end of last year, but the Reserve Bank keeps telling us that it wants to get it closer to 4.5, 4.7% because it's wanting to help sluggish wages growth. Last year, in 2019, we added 262,500 new jobs. And Andrew, that was much the same as the year before. But putting things into perspective, when we were booming along in 2017, we created 415,000 jobs. So it's heading in the right direction, but there is still some spare capacity. People are underemployed, aren't they?
Well, that's right. We've got to understand that part of the decline in overall jobs growth, Michael, has been that we've seen a decline in migration. Migration numbers are down quite sharply in 2019 compared to 2017-18. Of course, that very record levels of net migration was a factor in that record jobs growth. So we have to understand that that's also now working its way into a reduced jobs growth environment. But I think that good luck in terms of the Reserve Bank getting their 4.5% unemployment rate. We have a 3.5% unemployment rate in the US, and that's really failed to generate incomes growth as would have been expected. I don't think a 4.5% growth rate, unemployment rate, will revive incomes growth in Australia. I think that other measures of macroeconomic activity such as inflation, incomes growth and GDP are now flatlining. And I think that it is the main game now is to keep a steady and acceptable level of unemployment and reasonable jobs growth. And I think if we maintain that our interest rate policy will remain set. And I think the other factors will just remain where they are because we're into this now long-term period of low inflation, low incomes growth. And other advanced economies are showing us that over the longer journey, this doesn't look like changing at all.
Well, you're mentioning inflation. It was up 0.7% for the last quarter reported, and that brings the annual inflation rate to about 1.6%. But Andrew, that's significantly below the 2 to 3% target the RBA is aiming at. I guess what you were saying is it's a very ambitious aim and unlikely to be met.
Well, that's my point, Michael. I think that we just forget about inflation, we forget about GDP, we forget about incomes growth, because that's now just bumbling along the bottom in terms of where we've seen it before. So it is all about the labour market, and we're going to need some really significant economic force to bring up demand for labour to the point where we will get incomes growth. And given issues over productivity and migration, that might not occur, Michael. We have to sort of get used to that. And I think the Reserve Bank is coming around to that way of thinking because it doesn't want to cut below 0.25%. It's clearly stated that. And perhaps it's what I'm trying to say is it's given up on incomes growth, inflation and GDP. As we've looked at the numbers as it's occurred in previous cycles, it has to realise it's not going to happen again. So we just need to maintain as robust a labour market as we can. And I think that means that interest rates are going to be around about these levels for a long time to come.
Another factor that's been in the news a bit is Australia's economy. At the end of last year, it posted its worst performance since the global financial crisis, hit by the drought, weaker consumer spending, sluggish business investment, and I guess the slowing global economy. It's working in a larger global economy. Recently, ratings agency Moody has downgraded Australia's economic growth forecast from 2.2% to 1.8%, and it was suggesting things like the bushfire and the coronavirus. Similarly, Morgan Stanley slashed its growth forecast from 2.1 to 1.9%. Andrew, there's a couple of headwinds, and I'd like to talk about them, but in the context of what's happening in the world, those aren't bad economic growth figures if we could achieve those, are they?
Well, no, Michael, it's all relative, I suppose. And as I said, I think this type of economic measurement is going to become increasingly irrelevant given the changes in circumstances or the changing nature of macroeconomies in advanced economies. It's a changed environment, and no surprise that the pundits are all changing their forecasts and slashing this and slashing that. I guess they're just getting a little sick of being wrong so consistently, but this is all a part of backward-looking analysis based on the sense that what happened before is going to happen again. It's not. We're in a different environment now. And as you said, GDP is its lowest level since the GFC. Even if we did move into a period of negative economic growth and we would get the headlines over 2 quarters of a recession if that occurred, I don't think it would have any impact on our economy in terms of those on-the-ground real economic measures such as unemployment, which we saw in our previous recession.
Sure. Let's have a quick look at some of the big macroeconomic factors that could be affecting us. Over the last little while, the US-China trade pact seems to have sorted itself out. Like we said at the end of last year, we knew Trump had come to the party because he's got an election year. So phase 1 trade deal's now been signed. Brexit has left the EU. And it's never been a big trading, well, it hasn't for a long time been a big trading partner for Australia, but it opens up the possibilities of greater trade with an old friend. I guess the elephant in the room is the coronavirus. It's still a developing story. And even the RBA stated in its minutes that it will have a bigger impact on the Australian economy than SARS. What do you see ahead with these headwinds, these factors that could slow us down? So let's start with the tragic bushfires. Lives have been lost, thousands of properties have been destroyed, a large part of our beautiful country has been devastated. What about the economic effect, though, Andrew?
Well, without trying to downplay, as you suggested, the serious and tragic nature of those catastrophic bushfires, in terms of its impact or their impact on the economy in 2020, I think that it'll be largely benign. Of course, we know that the government has committed itself to significant funds to rebuild. There's been tremendous donations right across the globe to assist in the rebuilding of the devastated bushfire areas. Of course, that will create economic energy through that rebuild. And certainly I think there are other issues that have come out of left field, particularly the coronavirus, that will have more of a significant effect than those terrible bushfires that we had in January.
Well, the coronavirus seems to be creating a second wave of economic disruption now in Australia. The first wave disrupted casinos, air travel, hotels, a bit of tourism. But now this new phase potentially is going to disrupt supply chains, with many Chinese factories still closing down. And unfortunately, tourism and education industries are both significant sectors of our economy, Andrew.
Yeah, absolutely, Michael. And our exposure to China is profound, and particularly given the issues over education. We have a very strong cohort of Chinese students that we rely on for one of our strongest export sectors. Tourism, yeah, it's more about the connections that our strong local community have for mainland China. There's always a lot of travel and interface between mainland China and Australian Chinese communities. Of course, that travel has now been significantly constrained. Also, interestingly enough, we still have a lot of interest in the property sector from Chinese investors, and that's also been curtailed. There's been a number of events that have been postponed because of concerns over the virus. And so I think that this will have an effect. Of course, it's still reasonably early days to see whether this pandemic can be controlled and at what level. But certainly our relationship with China, significant as it is, means that there is likely to be some sort of negative consequence to our economy going forward.
Well, all these things are going to impact on consumer confidence. And it's interesting because last year, the 3 interest rate cuts, the reduction in personal income taxes, all that failed to lift the mood of consumers. They seem to be more content in paying down debts and saving, Andrew, rather than increasing the spending with their new household income. At the same time, I think all this is going to knock business confidence a bit. It's weak, it's struggling, it's going to potentially affect employment growth and business investment.
Well, that's correct, Mike. It really is an unknown short-term outlook anyway. I think that the interest rate cuts were never going to supplant what's been a very weak period of incomes growth in the economy over a number of years. And I think that's, as I said previously, is a new reality, that benign incomes growth is part of the reality going forward. And I do think that it's important that the government perhaps shift its focus more, as we've discussed, to fiscal stimulation. And of course, if that becomes the main game, then issues such as decline in our income from export sectors because of issues such as reduced confidence and perhaps reduced activity from China will have an impact going forward on our economy.
Now, just to round it all off, it sounds very negative. Coronavirus, Middle East tensions, the economy down. It's actually not that bad. I think we've got to put it back into perspective that there are always ups and downs in our economy, and there are more positives for us. We live in a great part of the world. It's at a good time in history. Our property markets at the end of this year, Andrew, are going to look much healthier. They're going to be in a much better position than they are at the beginning of the year.
Well, we had that U-turn or that sidetrack last year, 2018 and into 19, thanks to the meddling from APRA and the fear campaign. As a result of that, we're now starting to readjust back to a normal market. Let's hope those mistakes that were made by various parties and policymakers right from 2015 through aren't repeated. But I think we'll get back to a very stable housing market environment by the end of the year. I think, Michael, this year is almost the easiest year in many years to predict where prices are going to end up. I think that we're going to see likely double-figure prices growth in Melbourne and Sydney this year, certainly 8 to 10%. driven by still a bit of catch-up energy, a surge in first home buyers, which is already occurring now from the new government's new first home buyer deposit scheme. More investors coming into the market, maybe one more interest rate cut. And of course, the point is that even if Melbourne and Sydney reach their previous peak points of prices by mid-year, perhaps even sooner, it'll mean that prices haven't grown in 2 years. So that again gives you more upside to growth given incomes have grown and interest rates are lower. So it will be a very positive year, particularly for the Melbourne and Sydney property markets, remembering they're in catch-up mode. But I think the smaller markets, Brisbane, Adelaide, Canberra, will revive, but not at those double-figure rates, but they'll certainly continue to grow. So a much more positive environment and a much more certain outlook in terms of property markets, Michael. And of course, the short-termism of economic factors is upon us again, as we discussed through the year, as we did last year. At the moment, it's the coronavirus. We have the US elections coming up at the end of the year. Brexit is off the agenda. In fact, the world economy is looking a little better at the start of this year than certainly it did a year ago. And I'm certainly much more relaxed about the outlook for global economies, given the remaining of those low growth environments. But I don't think we're going to see any of the recession mantra that we were driven early last year and through the middle of last year. And of course, as you so rightly suggested, Australia is in a great position compared to the rest of the world. We still have very strong export sectors that support a very small population. And I think that given the fact that we'll now move hopefully into a policy position of fiscal stimulation, we'll be able to, given that we have a budget surplus, although a small one, perhaps think about a deficit funding environment where we can start putting more money in people's pockets. And I'm not really talking about infrastructure spending. I'm talking more about taxation relief and other positives that'll be more of a stimulus to consumption, which is clearly what we need in our economy at the moment, Michael.
Well, thank you for that amazing roundup. That was great. And I look forward to catching up with you next week for our weekly Property Insiders video.
Thank you, Michael.
We covered so much with Andrew Wilson, but if you'd like to get more information from Andrew, from me, from Ken Race, Australia's leading property tax expert, or a group of local property experts, why not join us at my National Property Market and Economic Update one-day workshops in Sydney, Melbourne and Brisbane? Go to propertymarketupdate.com.au. The link will be in the show note, propertymarketupdate.com.au, and use the coupon code podcast so you can be my guest. They're coming up soon, so reserve your place. And if you did enjoy the show, why not pass the message on to a couple of other people? My quest is to make as many people as financially literate as possible, so I'd love you to help me. So just tell somebody about the show or use the share button on all the podcast apps, or you can tell the world. Leave a 1-star review, a 5-star review, as many as you like. I'm really happy to say they're almost all 5-star reviews, and if I read them out, as I'm going to read out 2 reviews today, I'd like to give you one of my books. So just, if this is you, email me, michael@metropole.com.au, and I'll gift you a book. And I received lots of reviews, so these are actually going back a little bit in time. The first one's from Askarung, who said, "Thank you, Michael. Hi, Michael. Thank you so much for your podcast. I really like your areas of mindset and hope to listen to you for years to come. You've helped me a lot. Thanks, Ashok." My pleasure. And there was also one from Barnstable, an Apple podcast that he left in January this year. Property Advisor podcast, pure gold, he said. "Michael, this was a brilliantly informative podcast. I wish I listened to it 5 years ago. We've learned some lessons the hard way." And he goes on to talk about choosing a poor buyer's agent, one that didn't deliver the results that were promised. And I understand your issues with that because, boy, there's a wide variety of experience. Everyone's now wanting to be a buyer's agent, Barnstable, you're right. And so there's some very inexperienced amateurs out there pretending to be buyer's agents. But anyway, sorry to hear about your issues that you mentioned in your review, but thank you for talking about how good this is. And he finishes off by saying, "I'm loving your informative podcast." So I'm going to be back again with you twice a week with the podcast, but in between you can catch Andrew Wilson and myself at propertyinsiders.info, our weekly video. You can follow me on social media, Michael Yardney, particularly Instagram. I'm actually getting a big following on that. I'm having fun getting to know people on Instagram, and of course daily my Property Update newsletter. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?